So the land certificate is just a replacement for collateral. And as Abraham said, the LIFT project had 40 million land certificates that is currently being used as collateral to microfinance institutions to borrow up to 70,000 birr. From a digital uncollateralized lending principle, we don't be, the practice demands that there is no collateral behind that loan. So you either use a set of data to validate either capacity or ability or willingness to pay. So these are the three things you measure. So land certificates in the world that we come from would add little value. Saying that, however, it can be used as an insurance to provide an underwriting service to collateralize uncollateralized loans. Coming back to Atotafari's question, I think there is some clarification that needs to be done. The phone locking is not a method of guaranteeing. It was one product of a bouquet of services that we have. So we have an overdraft product, a micro product, a small product, an agricultural product, and a phone device financing product. On the phone financing device product, we have a locking technology that if you borrow using our technology to buy a phone, then if you don't repay the phone repayment, then the locking technology will lock the phone to make it useless. So we need to, that clarity needs to be there. It has nothing to do with the other products. When it comes to the other products, it really works again on the three principles: ability to pay, and how do you measure it using data, or capacity to pay, how do you use data to build algorithms to measure credit worthiness or credit scoring, and then willingness to pay. I think that's what you asked in our culture. Is there a resistance to willingness to pay? And that's like a psychometric algorithms. So we have three sets of algorithms that use different sources of data and triangulates it to give you a credit score and a decision engine to how much you can borrow on your income. So you need to be clear that there is no connection between phone locking and credit scoring. The identity is very key. We see that identity as you scale. Without it, as Yodahe was saying, digital lending or uncollateralized digital lending will not work. There is no country case that we have come across at scale. And when I talk at scale, and that's where journey becomes important. Today you start with 10,000, the next month you go to 50, and once you pass a certain amount of zeros, then it is impossible without identity to manage such, whether it's duplication, whether it's return of loans, and it becomes a key part. And that's why I think we are working with Yoda and his team to integrate into the national ID. In terms of Ato Malaku's question, uncollateralized because the premise of these products for micro, small, and medium enterprises starts by saying they don't have collateral. Then how do you engage a potential customer, consumer, to provide him with a non-collateral based credit? That's why uncollateralized becomes key part of the product definition. An MSME cannot bring any form of collateral. So in Ethiopia, if you see, there is somewhere between 10 to 12 micro, small, medium enterprises. So there are about 12 million that starts with the informal sector cleaner all the way to the medium industry owner that does not have collateral. So how do you now replace from the 5 principles of credit? How do you bring character? How do you bring capacity, ability, and willingness without the need for collateral? The journey part that I was referring to is setting, for example, for us, the Kanna product has taken us 5 years of data sets. We have a data lake at the moment where we have, I think, I don't know, maybe 5-6 million worth of data sets that we have built by following MSME's capacity, whether it's capital growth or employment growth. We have a data set that looks at where we found data, payment. We have a psychometric algorithm that we have adopted from the World Bank that has been piloted in Ethiopia some 10 years ago and then dropped. We have used that with the help of them and to measure willingness. So data set is not simply analytics, it is designing algorithms and allowing them to learn and improve through machine learning their quality of scoring. So if you go to the States, for example, they score you from close to 400 or 500 to 800. So 300 would mean you are not creditworthy, or you need to have a higher interest rate, or you need to have a shorter repayment. And 800 would mean you don't need any form of advance payments, lower interest rate, and maybe 5 years or 10 years repayment. So the decision engine that we have built is very similar to that. And that's a choice that you take. For example, in Kenya, Tala took a different route. They used building social media data to score people. So at the moment, they have a set of 5 or 7 years of worth of social media data that they have built an algorithm that tells residents of Kenya or people that live in Kenya whether they are creditworthy or not. So it is choices. Companies make different choices of what data they would build algorithms on. So uncollateralized is key because that's where it starts. The MSME does not have a collateral. In terms of, I agree with you, additional value is reach, cost effectiveness, and decision-making simplicity. I agree with you.